Kia ora, and welcome to Tuesday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz, and today we lead with news financial markets have turned cautious, unsure of what to make of the set of tariff letters. In Washington, because they couldn't complete tariff deals in the 90 deals in 90 days timeframe to July 9, they've moved the deadline to August the 1st. The shambles extends. And the capricious tariff letters are starting to be issued, first to Japan and South Korea at 25%, then a bunch of developing countries, including Malaysia, also at 25%, and South Africa at 30%. Essentially, the US is pushing countries into China's orbit, and creating conditions where many will shy away from buying US goods due to the bald insult. US businesses are likely to suffer not only from the financial market reactions, but also on the demand front. Other governments' trust in the US is in free fall. Separately, we can also report that the New York Fed's Global Supply Chain Pressure Index was neutral in June, back to its long-run normal level. That amounts to an easing of the May pressure as the rush to beat tariff taxes faded. Across the Pacific, China said its foreign exchange reserves rose by $32 billion to $3.3 trillion in June, and that's its highest level it's had in nearly 10 years. And Singapore's foreign exchange reserves stayed very high in June, even if they did dip marginally from their record high level in May. In the EU, they report retail sales by volume, that is inflation adjusted, and it slipped in May from April. But it stayed higher than year-ago levels, although by less than 1%. Meanwhile, Germany reported its May industrial production, and it turned up and by much more than expected. Although, to be fair, it is in a bit of an overall yo-yo pattern. Still, on a volume basis, it too is 1% higher than year-ago levels. So overall, even though some of it is over a month old, this set of second-tier data from the US to Asia to Europe isn't painting a picture of special stress. How the Australian Central Bank sees it will be revealed later today when the RBA issues its decision on its cash rate target. Market pricing has only 2/3 of a 25 basis point cut priced in, although most economists think it will happen and take their policy rate down from 3.85% to 3.60%. That will flow through to homeowner household budgets quite quickly because most have variable mortgage deals. However, it is far from certain this will give the Aussie domestic economy the boost a rate cut should deliver. It almost certainly will juice up house prices, which are already rising in anticipation. But existing borrowers seem to have decided en masse that the cash gained from lower rates will be used to pay down debt rather than be spent in generating more economic activity, which is why the RBA is cutting. To get that effect, the central bank may have to cut again later in the year. There are reviews in August, September, November and December yet to come, so plenty of opportunities for more rate cuts. The US Treasury 10-year yield is now at 4.39% and up 6 basis points from yesterday. And the price of gold will start today at $3,332 an ounce, down $4 from yesterday. American oil prices are up $1 at just under $67.50 a barrel, while the international Brent price is now just over $69 a barrel. And the Kiwi dollar is now just on 60 US cents, down an outsized 60 basis points from yesterday. Against the Aussie, we're down 10 basis points at 92.4 Australian cents. Against the euro, we're down 20 basis points at 51.3 euro cents. That all means our trade-weighted index starts today at just under 67.7 and 30 basis points lower from yesterday. And the Bitcoin price starts today at $107,923 and down 0.9% from yesterday. Volatility over the past 24 hours has remained low, just on plus or minus 0.8%. You can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.